Hey, good morning, everyone.
Good morning, Professor.
Hey, good
Good
morning,
morning,
Abani.
Professor Han.
Hi, good morning, Abani. Let's see. Let me adjust my volume here. I mean, it's just my speaker volume, not microphone. Um, all right. I see 10 people. I see one more person is joining.
Good morning, Professor. I see that you sent out a link regarding to the grade for the exam, and
Yeah, yeah.
but I don't see when I click on the link, it's closed.
What do you mean it's closed?
The the link it doesn't allow you to
It doesn't
access it.
open. It doesn't
Yeah,
open?
it doesn't open.
It should
It doesn't
open. I
open.
mean, it must. It depends on your, most probably it depends on your computer setting, right? So if your computer, so maybe it's your browser, maybe it's something else, but this is it, right?
Yeah, when I click on it, it doesn't open for me.
No, no, it's
It's
gonna
not like that.
download.
It gives me an error, say that it does not exist or
It
something.
doesn't even. It doesn't download. I mean,
No,
it's
no,
an
no,
extra.
not that. It says
Huh?
it doesn't. Let me check on. Let me open it right now. The error. Oh, now it works. It was working this morning. Oh, it says file or directory not found. The resource you're looking at might be removed or changed or is temporarily
No, no,
unavailable.
it's there. You just saw it. I just downloaded it. It was
Yeah,
just
I'm
downloaded.
clicking on it right now. That's the error code I got. 404.
Well, then it could be your computer setting. I mean, if everyone is experiencing the same thing, I should be experiencing the same thing as well, because it's the blackboard, not me. And if you are the only one experiencing that problem, then it must be your computer setting. It
Mm-hmm.
could be your browser, or so. Try this. Use a different browser. Try using a different browser, or just
Mm-hmm.
update the existing browser. Update the browser that you're using. Or if it still doesn't solve the problem, um, contact the e-learning, right?
Okay,
Contact
thank
the
you.
e-learning. Okay. All righty. So let me just check how many people are. Okay, this is oh, all right. I think this. So let me make sure that I have. Um, so I see 14 people so far, and I should have also 14 people there. Looks like, I have only 12, so two more people need to join us. All right. Um, yeah, usually, as I said, uh, if something doesn't work correctly with your browser, it's most likely, your browser setting, um, or generally the computer setting. So in most cases, you will have, okay, today, 19, right? All right. So by updating your browser, or switching the browser to something else. I mean, if you're using Google Chrome, you may, switch to a Firefox, or what's that? Microsoft Edge. Um, then most of the times it's gonna resolve the problem. Um, Otherwise, if it's still, the problem persists, uh, look, I'm not the IT person. I'm not the IT. I cannot solve that problem for you. You will need to contact the IT department of BMCC, or e-learning. I think e-learning is the most All righty. So last time we were talking about, we were talking about, present value of growth opportunity. I mean, present value of the growth opportunity is the difference between zero growth stock and growth stock. So in other words, excuse me, even before starting, getting frog in my throat. Give it a few, okay, give it a few seconds. So that was, yeah. And this whiteboard updated automatically, without me knowing. And then now, this, I don't like this, this is a newer, okay, this is the newer version of the whiteboard, but this is not what, this is totally wrong. I mean, not the way I want. Of course, they don't care. Microsoft doesn't care, the user, the benefits to the users. They just care about the benefits to them. I mean, whatever costs less. And then if they don't have to upgrade this, there's no reason. I mean, if it is, if the result isn't better, it's better, I mean, it's better not to upgrade. For example, Excel for Windows 11. I mean, that's not necessarily for Windows 11, but let's see. The way Excel, okay. I don't like this version. Previous edition was better. There's too much unnecessary dead space, dead area. That's totally useless. I don't need, this area doesn't need to be that large, but there's a wide area on top. That's reducing, that much is wasted. I mean, if I had only a very narrow band here, only a narrow band, only the necessary narrow band, you have more, viewable area. You can have more, viewable area. But the way it is now, I don't like this. This is crazy. And the same thing with the with this thing. Okay, so think about it. We know price. Let me increase this a little. This. The price of the stock at time zero. Again, this is more like P is usually market value, market price, but for convenience, because we're talking about price earnings ratio, I'm using P to refer to the intrinsic value. Okay, so don't get confused. Just because it's just because we're talking about price earnings ratio. So we all know price of the intrinsic value of the constantly growing, I mean, stock that is growing at a constant rate is dividend over K minus G, right? Which is the golden growth model, right? Which can be also rewritten as earnings per share times 1 minus B plowback ratio, right? Because 1 minus B is the dividend payout ratio, right? Only a small portion of earnings per share will be paid out dividends. So if B is big, then payout ratio will be small. And then K minus, we know G is, growth rate is ROE times plowback ratio, right? But now let's think about the price of the no growth form. No growth, okay? No growth, right? Company that doesn't grow. It will just be, think about it, because it's not growing, that means what? One minus plowback ratio is 0 because they pay out all the earnings, right? They pay out all the earnings. And then think about it, then K minus G, this part will be also 0 because ROE times plowback ratio is 0, right? So what does it become? It just becomes earnings per share over just K. Now, this is typically a company, right, that doesn't grow at all. And by common sense, if the company doesn't reinvest in its growth, right, it won't grow. And by paying out all the earnings to the shareholders, then the company can't grow, right? So by any common sense, right, price of the growth firm will be greater than price of the no growth firm, right? Which means then obviously price of the growth firm minus price of the no growth firm must be positive, right? The difference, it should be positive. And the difference will be, so that leads to and that means price of the growth firm is the price of the no growth firm. And what would explain the difference between the two? The present value of growth opportunity. Okay, the present value. So what makes the difference between the two is the present value of the growth opportunity. Okay. So this is basically it doesn't allow me to So this is, basically explaining the difference between the two, right? But again, present value of the growth opportunity. Last time I said this very clearly. Present value of growth opportunity is nothing but, this is, it can be, it's just, it's just an empty, hollow concept if it doesn't realize. As I said, some companies, completely outrageously overvalued, right? Overvalued by, if you look at P ratio, you can tell whether it is, it's, if this is high, it's one of the two reasons. One, it's just completely overvalued, right? It's just inflated. And then why it is why is it so inflated? Why is it so overvalued? Because of all those noise, because the market participants are not rational, investors, in other words, they say market is rational in the long run, but market is irrational in the short run, right? Because someone says, some rumors, this company has, FDA approval pending, blah, blah, blah. How do you know that? Someone, who tipped it in the first place? Who knows that? It would have to be an insider. If an insider tipped it, then it's an insider trading. The insider, some executive of that company, will be, punishable, seriously, punishable by law. You can go to jail for, many years for insider trading. So if you have that kind of information, you heard it from someone, who heard it from someone, and who heard it from someone, that's insider trading, first of all, and you don't know if it is really valid information or true information, right? And if it is true information, but how can that information even reach you? And let's say you are an average Joe, or average Mary, average Jane, or average Joe, an average Joe who has no understanding of stock valuation models or whatsoever, just hears these rumors, right? But there are many average Joes in the market. Actually, think about it. Those who are in the stock market, those who are eagerly watching their portfolio every day, are mostly senior citizens. Why? Because their retirement fund is completely, their post-retirement life depends on their portfolio. And some of them are well-trained, well-educated in finance, but and there are tons of people who don't study, but just, buy stocks, they trade stocks, and in a colloquial expression, they say play stocks. They play stocks, and sometimes they are lucky, and they think, they get overconfident. They get they have this hubris, right? Overinflated hubris, just because they won once or twice. So because market is full of average Joe and average Janes, average Joes and average Janes, sometimes, it can be overinflated. And the reason, if it is overinflated, that means, present value of growth opportunity is actually zero or very low. Very low, right? Close to zero. And sometimes this gets realized. It's a positive present value of growth opportunity is significantly positive, significantly. But how do we know that? So I said whether it is just a flop or whether it has basis. How do we know that? That's why I said in the last time. That's why you have to look at the fundamentals. Fundamental analysis is important. What was their earnings per share? What was their return on equity? What was their return on assets? What's their current ratio? What's their debt ratio? What's their debt to equity rate? What's their fixed assets turnover ratio? What's their inventory turnover ratio? All these things, you need to look at them. And then, but if you don't have time to do the fundamental analysis, then what? Then you gotta then what you need to look at is the PEG ratio. So what's a PEG ratio? PEG ratio is basically price earnings ratio over earnings growth ratio, earnings growth, right? So the idea is simple. And again, let's take if PEG ratio is 1, it's fairly priced or exactly valued. If PEG ratio is less than 1, undervalued. PEG ratio is greater than 1, it's overvalued. And why? The logic is simple. It's based on a very simple logic. Suppose the PEG ratio is, let's say, suppose the PE ratio is 200. Think about it. It's like the stock price is $200, but the earnings per share is just barely $1. Okay, and I've been telling you in general, the lower the PE ratio, the more earnings power it has. So in other words, the reciprocal of that, earnings. Remember, earnings yield or earnings price ratio, the reciprocal of P ratio, right? Think about it. If the reciprocal of P ratio, we know it's earnings yield. And this looks, by any common sense, this is like gas mileage, right? This is like gas mileage because this is the output. And this is the input, right? It's output to input ratio. So just like the gas mileage, it makes more sense, right? But then, Inverse gas mileages are used also. There are inverse gas mileages in the rest of the world. Only U.S. uses, miles per gallon, right? Maybe Canada also uses, kilometers per liter, but in the rest of the world, it's a liter. How many liters per kilometer, right? How many liters of gas per kilometer? Why? Well, because for them, U.S. is abundant. At least U.S. is endowed with petroleum, right? U.S. has a lot of petroleum. Um, uh, Not only land-based petroleum, but there's a shale gas, right? Shale gas, offshore, and around 2014, I believe, it was during um, Obama administration, they found huge shale gas reserve, right, off the U.S. coast of especially U.S. East Coast, right, which can last for the next 200 years at least. But U.S. just isn't pumping up. I mean maybe it's gonna be sort of like there's a strategic reason, a strategic reason. When the world, Saudi Arabia or Middle East, Venezuela, whoever, oil producing countries, when they run out of oil, still U.S. will still have oil, right? And even in Pennsylvania, as you don't have to go far, even in Pennsylvania, they pump up the oil, fracking. Fracking is not good for the environment, so it's discouraged. But if it is necessary, they will even use fracking to pump up the oil from Oklahoma, or the only reason, although U.S. has a lot of oil reserves, the only reason they depend on the import is because it's cheaper to import. But if it is no longer cheaper to import, then they will exploit the resources that we already have, right? All righty. So okay, why did I talk about gas mileage? Because earnings yield is more like gas mileage, output to input ratio, whereas the reciprocal of that is price earnings ratio. And other countries, I told you, other countries also use inverse gas mileage, because for them petroleum is a very precious resource. Most of the countries, right? It's not abundant. So anyway, the point was, so why? So think about it. If PEG ratio, if price earnings ratio is 200, that's extremely pricey stock for its earnings power. Just to earn $1, you pay $200. That's crazy, right? But the reason it is this type of price earnings ratio is maintained is because it is a hot stock. No matter what, it could be a rumor. It could be, that's old noise, in the, every rumor, every misinformation, it's all noise. But whatever the noise may be, the irrational average Joes and average Joe and average Jane are demanding that stock. That's why the price is supported. That price is supported. But it could be, it could be a real thing. It may be, well-founded on the valid, valid information. But whatever it may be, it's got a huge, price earnings ratio. And then suppose their earnings growth. In other words, earnings growth rate means what? That's the profit. Net profit is growing also by 200% annually. 200% annually. And then just temporarily, let's ignore this percentage, right? Because 200% means only 2, right? Ignore the percentage. And if you ignore the percentage, right, then this ratio will be 1. The PEG ratio will be 1, right? So think about it. A company that grows by 200% a year, a company whose profit grows by 200% a year, wouldn't that be a hot company? I mean, wouldn't that be a company that you would want to hold? Huh? No matter, I mean, that will justify this hot demand for this company. It will justify this high price earnings ratio, right? A company that grows, whose profit grows by 200% a year. So that's the rationale, that's the reasoning behind PEG ratio. And then think about it. If the PEG ratio is not 1, what does that mean? If the PEG ratio is not 1, so if PEG ratio is less than 1, what does that mean? There will be a case where something like, price earnings ratio of 100, but 200% growth rate. It's clearly undervalued, right? This ratio is 0.5. It's clearly undervalued, right? And I've been telling you, undervalued assets are always a buy target, right? It's cheaper than what it really should be worth. It's cheaper than what it is really worth. So sooner or later, there will be an upward correction, right? The price will go. If you buy now, you can sell later at, a higher price. And it's exactly the mirror image. It's exactly the mirror image, vice versa, right? If the PEG ratio is greater than 1, it's overvalued. It's like, PE, price earnings ratio is 200, but it grows by, profit grows by only, 10% a year. Obviously, then, this is what? 20. The ratio will be 20. And this is not a good stock, right? Clearly, it's nothing but, full of, it's a balloony. It's full of hot air. It's just full of hot air, right? That average Joe and average Jane, being irrational, are making a very stupid, they made a stupid choice, a stupid decision, right? I mean, just blind decision, blind investment. Why? Because that average Joe next door says, buy this, buy this. I know a guy who knows a guy who can get you a great deal. Who said that? Huh? I know a guy who knows a guy who can get you a great deal. Who said that? Donald Trump, right? I know a guy who knows a guy who can get you a great deal. Donald Trump, right? This is exactly the blind irrationality of average Joe, average Jane in the short run in the market, in the stock market. Now, so here's a small exercise about the relationship between or the relation between plowback ratio and growth rate, and the growth rate and P ratio, right? Think about it. I'm gonna, this will be your, okay, I prepared a small table, right? I replicated a table here in Excel file. I want you to do this. Open a blank Excel file, and build this. But do not, look, do not just enter the numbers, right? Do not just enter the numbers. Here, I'm gonna initial input data must be there. So do this, please, now. And I'm not posting this template there. At least you should be able to build a template, very simple template like this on your own. This will be your homework. Okay, this will be your homework today. I'm going to post, during the break, I'm going to post an instruction about this homework. And you should submit it by midnight, 11:59 today, 11:59 tonight. It won't be difficult, but once you do this, it's not a difficult thing. First, cost of capital. And I want you to use, look, what did I use? Font, size 14. I used, Baskerville, whatever the font that is closest, but I want you to use, Georgia Pro or Times New Roman only. Okay. Now, K is the required return, right? In other words, K is the R, right? The discount rate. Plowback ratio, 0, 0.25, 0.5 by the increment of 0.25. First, and then ROE, return on equity, is 0.1, 0.12, 0.14. And let's find, at part A, let's find the growth rate. And we know growth rate is the ROE times plowback ratio. Then, all you need to do is, what's our ROE here? Times plowback ratio. This one, right? That's going to be 0. And then let's change. Let's lock this, okay? Because A5, when ROE is 10%, but with varying plowback ratio, right? You want to so B2 will need to change as I drag it to the right, but A5 shouldn't change. So I will lock that. I will lock A5 and drag it to the right. Okay, and then let's this time I'm going to unlock A5, but lock B2. F2, right? F4, lock B2. Why? Because I'm going to drag it down so that I would know the growth rate. That will yield the growth rate when ROE is 12%, 14%, with the plowback ratio fixed at 0, right? Then I drag it down. Of course, it's going to be 0 because when you multiply anything by 0, it's going to be 0. Here, I will unlock A5 and lock C2. What am I doing? I need to hit F4, right? And then enter, enter. Okay, drag it down, and you will see, and then the same thing. I will but then lock D2, and then drag it down. Okay, and then make sure also then these are the growth rates, right? And then P ratio, right? First, it's 1 minus B, right? Or K minus G. K is there, and because K doesn't change, right? We'll just lock it because it's going to be A2 all the time. And then growth rate here, right? Growth rate at B5, right? And of course, you'll have to close the. And then if we B2 needs to be locked because, okay, and then you drag it down. Yeah, it will always have to be the same thing. And this time, we'll drag it to the right, and it's not going to be B2. This time it's going to be plowback ratio is C2, right? So I will lock C2, and then you drag it down. A2 minus. Okay, so I did a couple of things, a couple of columns, but make sure, see if you're getting the same result. So our growth rate, yeah, 2.5, 3%, 3.5, and then plowback P ratio 7.89, 8.33, 8.82. Yeah. So please don't just copy these numbers. Don't copy those numbers. You must have the correct formula in there, right? When I look into that, in other words, in those cells, you must have, no. When I turn it into a formula view, oops, why isn't it? Okay. Okay, my keyboard isn't functioning well today, but when I look into the formula view, it should be, it should have the correct formula in there. Okay. If it doesn't have the correct formula, then you don't get any credit. So please I will, as I said, I will post instruction during the break. Uh, this is due tonight, 11:59 p.m. And if you get it right and you send it to by email, I will um, the instruction will clearly state, how to name the file. Uh, the file name should include your last name and first name so that it can be identified. So in another class, uh, when I gave homework, some students, submitted, just attached the file without naming the file. Then, once when it is downloaded, how do I know whose work it is? It's just a thinking, I mean, if you the difference between the manager and the just a mere employee is that the manager will have to the manager has to have a system that will be organized, well systematically organized in such a way that everything is well sorted and well in order, right? But a mere employee doesn't. In other words, they don't see it from the bird's eye view. You have to have the vantage point from which you see the whole picture, so that everything will work systematically and organically in a well-balanced way. But a mere individual employee cannot see that. So they think, it's made by me, so it must be mine. Look, when it is submitted, if it doesn't have your name on it, it cannot be identified. You cannot, no one can connect it with the owner, right? So anyway, that will be, and if you get this right, you get 2 participation points, 2 points for participation, right? 2 points for participation. Okay. All righty. So that brings us to this example. This example is an interesting example. This example was, from Peter Lynch. And Peter Lynch is a legendary fund manager in the 70s and 80s. I don't know if he's still alive, but if he's alive, he would be well in his, 80s. I think he was with Vanguard or whatever. But during his heydays, right? That was 80s. I think 70s through 80s. Mostly 80s was his heydays, I think. He persistently beat the market. That means outperform the market for about 2 decades. So beating the market persistently for even 5 years is a difficult thing. It's rare feat, but he defeated consistently the market for almost 2 decades. So and he published, I don't know if he published or he it's introduced in the textbook, but whether he really published it or not, or whether he just introduced it in one of his presentations, maybe just presented in one of his presentations, right? So basically the point is PG ratio, right? If PG ratio is 1, it's solid. Now, so we assume that risk-free return is 8%. That was the risk-free rate about when Peter Lynch was writing this article. So that's Treasury bill, right? Risk-free return is Treasury bill, right? Short-term 1-year short-term Treasury bill return is considered risk-free return, right? And you finance majors, you all know that. And this basically uses CAPM, right? So you need to know. So market return minus risk-free return is also 8%. So that means market return, average market return was 16%. And this is the market risk premium. Market risk premium. That was the historical average during, in Peter Lynch's time. Beta was 0.4. I'm sorry, not beta, but plowback ratio. Plowback ratio was 0.4. That was also a typical value. Excuse me. Plowback ratio 0.4. That's, I don't know if it is typical nowadays because, of course, it depends on whether it is a growth farm or mature farm. If it is a mature farm, plowback ratio will be much lower. It's mature. If it is a growth farm, plowback ratio will be much higher. But that if plowback ratio is 0.4, that means dividend payout ratio is 0.6. That's rather high. Huh? And then we assume 16% for the required return, right? For an average company. Average company is a company with beta of 1. In other words, the volatility of returns of this company is just about the same as the market volatility, right? So accepting as reasonable ROE of 16%, right? If the required return is 6%, 16%, and the required return is 16% on the stock, and return on equity is 16%, and that's quite reasonable because the investors will generally expect, right, the same, the required return that would be about the same as the return on equity, right? As an equity holder, I want my stock to return something like the return on equity of this company. So then growth rate will be 16% times 0.4, 6.4. The P ratio will be 1 minus plowback ratio over K minus G. It will come to 6.26, which is roughly equivalent to, the P ratio will be roughly equivalent to the growth rate. If the P ratio is roughly equivalent to the growth rate, this firm, this stock is fairly valued. This stock is, under these assumptions, consistent with the rule of thumb, this firm is fairly valued. However, it's not always the same in all circumstances because some variables may change. What if the yield on the treasury, RF, risk-free return, is 3%, right? A comparable, then, the required return will have to be, now using the CAPM, this is CAPM, right? And you all know what CAPM is like, and that was, that was discussed in Finance 100, right? We all know. Basically, it was originally like this. Is CAPM's original form is right. So this is what this is the individual stocks risk premium, right? That particular stock X, stock I, right? I meaning that individual stock, right? Individual stocks risk premium, right? Risk premium. And this is the market risk premium. And this is the beta of that particular stock, right? And if we rearrange this, okay, if we rearrange this, so by this, RI, if risk return on the stock I is risk-free return plus market risk premium, and the risk-free return is now 3% plus market risk premium is 8%. And then it becomes then it's 11%. Now then growth rate will be then RO and because we assume that ROE will be like required return, so ROE times plowback ratio 4.4, while and then P ratio will be then 9.1, so PG ratio will be greater than 2, right? So then what does that mean? This is going to be now it's going to be overvalued, right? It's an overvalued. The P ratio and G now diverge, and the PG ratio is now 2.1. Nevertheless, lower than industry average PG is still widely seen as signaling potential underpricing. Yeah, you don't base it only on the PG ratio. I mean, although by this number, PG ratio very greater than 2, or like 9.1 is 9.1 is a P ratio, but 9.1 divided by 4.4, that will be greater than 2. Although by PG ratio per se it is overvalued, it's almost like twice overvalued, double overvalued. But if this is less than the industry average, if the industry average is a PG ratio, industry average is like 4, it is still undervalued, right? Potential underpricing, right? The PG ratio for the of S&P 500 over the last 20 years typically has fluctuated within 1 to 1.5. Okay, a typical S&P 500. So the index, S&P 500 index, which is a rough approximation of the market. On average, it has been 1 to 1.5. Okay. Alrighty, I believe this is a good time to take a break. So after the break, we're gonna do this. We're gonna start with this exercise. What happened? All righty. Um, let's take a 10-minute break. Okay, shall we? All righty. All right, we're back. We're back. Now I see 17 people here in the collaborate session, and in the forum, I have 21 people. So 4 people are missing, right? 4 people are missing. Um, but it's very important that you stay logged in and pay attention to the collaborate session, because from time to time I give out some impromptu assignments, and I just, you may, I don't know if you have noticed, I sent out, right? I just posted this instruction for uh, the table 13-1, right? Uh, so I demonstrated basically, what to do. I mean, it's not a difficult thing, but uh, actually being able to replicate, what the book presents as uh, what the book presents, uh, that's very important, because it solidifies your understanding, right? It definitely solidifies your understanding. And um, most of the tables and examples given, you take it for granted, but actually being able to do it and just seeing it are two different things. So I, so basically, you would understand, what I'm saying if you do it. Okay, so as we came back, this is an exercise, actually, a small exercise. So let's take a look. Concept check 13.5. ABC stock has expected return on equity of 12% per year, and expected price earnings ratio. I'm sorry, earnings per share of $2, and dividend of $1.50 per share. Its its K required return is 10% per year. What are its growth rate? And all these are called expected. I've been telling you this is called expectations operator, meaning uh, it's at time one, or in the future. I mean, generally, we are, think about it. Um, we're not talking about the past, because in finance, everything is, basically uh, the fruit of investing. The fruit of investing are born in the future, right? Uh, so basically, what is relevant, what we want to know is, what's the present value of that future cash flow? So it's either, future or present. Past is not. So anyway, what's the growth rate? First, it's a three-part question. What's the growth? What's the growth rate? What's the price? And what's the P/E ratio? Uh, and I demonstrated here. First, growth rate is, ROE times plowback ratio. We have ROE of 12%. Plowback ratio uh, isn't given, but if the dividend is $1.50 and earnings per share is $2, from $2, $1.50 is paid out as dividend. So what does that mean? Dividend payout ratio is uh, 3/4, right? Or 75%. 75%. Isn't it right? Dividend payout ratio is 75%. But then plowback ratio is 25%. So then, look, so uh, growth rate is ROE times plowback ratio. So that's ROE times, earnings per share minus dividend over earnings per share. That will give you the plowback ratio. So 0.12 times 0.12, 0.25, 0.03. That's the growth rate. And the P ratio, it's 1 minus plowback over K minus growth rate. So 0.5, 1 minus B is the D, dividend payout ratio. So 0.75 over 0.1 minus 0.03. So P ratio is 10.71. And the price should be P ratio times earnings per share. It should be 21.42. Okay. So that, explained there. And then let's take a look at the second example. If the also as we do this, if the plowback ratio is 0.4, what would be the firm's expected dividend per share? Growth rate, stock price, P ratio, and PG ratio. So let's do this. This will be your homework as well. So if you get this right, another 2 points for participation. So let me revise this. Concept check 3. That was concept check 3.5, right? So this is your homework. I'm gonna revise. I'm gonna revise the homework instruction during the break. So there is also concept check 13.5. I think. Table 3. What is table 3.1? Okay, I will revise it later. Okay, and then 1. So. And then 2. Okay. So I will revise it later, and you will get another email. Okay, so that is the and we already understand quite a lot about the P/E ratio. Ceteris paribus. That means, all things being equal, riskier stocks have lower P multiples or more lower P ratios. And these 3 dots, put upside down, that's since, because, right? You have mathematically, no, what is this? Mathematically, these are logical expressions, 3 dots like this. This means therefore, right? Why is it? And the inverse of that means because, right? Think about it. Logically, they are logically, opposite, right? Therefore, right? And since or because. Okay. That looks like a face, but what do I do? Okay. Because higher required return, right? I mean, risky stock will have higher required return, right? Because investors will demand higher return from a risky company, right? So K goes up, and if growth rate is constant, right? K minus G will go up, and as this goes up, P ratio will go down, right? On the other hand, mature firms can also have lower PE because if they are mature firms, growth rate will be low. If growth rate goes down, and with whatever K, as long as K doesn't go down, right? If K is constant, right, then the K minus G will go up, and the P ratio will go down. But again, here's the thing. If it is a mature firm, because it's not risky, required return may not be high. So in other words, what I'm talking about is okay. Let me. Where do I write it? I guess this is a good place. P, because P ratio is basically 1 minus B over K minus G, right? A risky company, right, will require, I mean, the investors will require a higher return from a risky company, right? And if G is constant, right, K minus G will go up. As K minus G goes up, right, because the denominator is getting bigger, the whole fraction will have to go down, right? The whole ratio will have to go down. On the other hand, so that's a risky firm. On the other hand, in case of mature firm, right, because it is a mature firm, right, the required return is not high. The required return is not high. And if uh, if growth rate is constant, right, the whole denominator will go down, right? And as the whole denominator goes down, then this will have to go up actually, right? The entire ratio will have to go up. But on the also think about it. This can go down too, right? Growth rate can. Why? Because it's a mature company. Mature company, mature company will growth rate of a mature company uh, isn't high, right? But then depending on whether uh, change in K is greater than or less than change in G, right? It can lead to a different story. If change in K is less than change in G, it may not go down as much, right? It may not go down as much. On the other hand, so not the it may not be exactly like this, right? Then it may not be like this. It can even, it can even go down as well, right? Uh, so, which effect dominates, right? And small risky startups have very high P ratio, small risky startups. And think about it. Startups generally startups have, huge growth potential. And if the startups have, let's say they have some technology that others don't have, it's a startup, but it has huge growth potential. That's, basically a huge present value of growth opportunity. Tesla was exactly an example of that. Tesla was like that. But it doesn't contradict the claim that PE ratio goes down with risk, because evidence of the market's higher growth rate a higher growth rate leading to a high price earnings ratio. Because if it is a startup with great PVGO, great growth potential, as growth rate goes up, right? As this goes up, K minus G will be smaller. And if K minus G goes down, mathematically, the whole ratio must go up. So, and this is why high-risk firms have low PE, ceteris paribus, right? Riskier stocks have lower PE. And in general, given a constant growth projection, P will be low, price earnings ratio will be low when risk is perceived to be high. So we don't want to, and basically, I'm not gonna go. We spent too much time on the P, but please go over this, because if you have already taken FNB 230, I'm trying to connect it with FNB 230. Okay. So here's an example. Please read it. I'm not gonna go. I'm not gonna spend time on this. Something you can just read up. Alrighty. Alrighty. Unexpectedly, I have a visitor. So, but it was scheduled. I mean, I just didn't know when he would be coming. It's you remember last Saturday, the window guy came here to take the measurement, and then he's back with the blinds, and so he has to install that. So I'm gonna have to put you on a break for like 10 minutes, 10-15 minutes. We're taking a little break. Yeah.
Professor, hi. I just
Yeah.
a small question when you are on break. Are we going to work on the Excel that you just sent? That well, like the spreadsheet pre.
Yeah. You can use this time to work on that. Yeah,
Okay,
definitely.
and
This
then
is the perfect time.
like when you come back, we're going to work with you on that.
No. You need to send it. You need to send it to me. Um, you need to email that to me because it's homework.
Yeah, I know, but I do have some questions, and then I don't know if we are working
Yeah. I will take your
together.
questions. I can take your questions, but I'm not gonna do the whole work because then you can just copy that work.
No, I know,
Right?
but like yeah.
Yeah, sure. Yeah, I'm gonna take your
Okay.
questions. I'm gonna answer your questions, and also I haven't completed the second part of the part two of that instruction, so I will finish up the second part and also repost it. Okay.
Okay. Thank you.
All righty. So I'm gonna have to put you on a 10-minute break, 10-15 maybe, max. All righty. So All right, we're back. We're back. Um, we're back. So that was an untimely break. But since we took a break already, all right, since we took an untimely break, right? Um, we're gonna continue on until 12:15 because it's like 11:19 now. So we just consider that as taking a little early second break. Okay, so we're gonna continue without stopping. So okay, I just revised that instruction and sent it out. So this is a basically two-part homework. One, and two, concept check 13.5. So they will be done in both, in the same Excel file, right? And total of 4 points. You will earn, if you get it right, total of 4 extra points. That's it's not scaled. It's not weighted points. It's just raw 4 points. So it's gonna be a huge, um, it's gonna be huge, because if you get 100 in, because the exams are weighted, if you get 100 in uh, the what well for exam midterm 3 and final are, I believe midterm 3 and final are 25%. Midterm 1 and 2 are 20% each. So if you get 100 in midterm 1 and 2, it's when weighted they are 20 points. But your participation points are not weighted; they are whole points. So so it really is a big boost. If you or really if you need to grab every point. And then so the second one, concept check. Let's think about the concept check. The concept check. This one is table 13.3. If we do, you don't have to do it in a separate one, but if you do it in the separate one, name it, concept check 13.5, and also highlight the whole worksheet and give it like 14 points. Georgia, or but you can use, go down to find Georgia. Georgia font is good. Georgia Pro is good too. Georgia or Georgia Pro, doesn't matter. But and what should be the what is the right variable there? Okay. So basically, ROE, not to make the table unnecessarily wrong, I put the initial inputs horizontally: ROE, EPS, earnings per share, earnings per share, and dividend, and K plowback ratio, right? So the original part one was, original question was, ROE of 0.12, right? Earnings per share $2 and $1.50 and 10%. Plowback ratio of 0.4, right? Now, given this, well, previously, I was like that, and then, okay, so expected dividend. Growth rate, stock price, font, subscript, and then P ratio, P and PEG ratio. Okay. I think this one is no longer needed. I'm gonna. Okay, the second problem, right? Concept check part 2 should be answered. I mean, using a table like this, it should be, answered systematically, right? And then it shouldn't be that difficult. First of all, oh, why is it happening? What's happening? Okay, dividend. Okay, so basically, the premise was given already. So it's only a matter of answering it by the right formula. So now plowback ratio is 0.4. That means we can tell what should be the dividend payout ratio? What should be the dividend payout ratio?
1 minus plowback ratio multiplied by the
right. So it's going to be 0.6, right? It's going to be 0.6. So maybe I did, let me leave the original data there still, it might come in, but let me give it, this is dollars, these are dollars, both of them are dollars. The rest of them are just, a percentage. So this will also need to be in dollars. But the others are, this also needs to be in dollars. Okay, and if you know dividend payout ratio, this can be answered, right? Growth rate, ROE times plowback ratio, right? P and one, you will need to find, once you find this, you can get this, and you can get this, right? Once you have P. So you need to build it like this. Okay, so this is the part, this is the part that needs to be answered. Okay, and what about, someone had a question about this, right? Someone had a question about, so what was the question? No question? Before the break, someone was asking someone was asking that he had a question about this. No?
Yeah,
Okay.
it was me, but no, I'm already good. Thank you.
Okay, if you're already good, then fine. So I just did some, examples here before, but it should be good to it should be good to go, right? These are the solution cells that must be answered. All righty. Okay, so then we'll we were talking about and then so there are some pitfalls with price earnings analysis, and it's got a lot of it's the problem of actually accounting. It's problem of accounting. I mean, there are so many loopholes in accounting, right? Then with that loophole, it becomes unreliable. If they are doing creative accounting, right? But let me before we talk about that, let me just briefly just skim through this. In the dot-com bubble of the late 1990s, companies yet to turn a profit were valued at billions of dollars. I mean, the companies, in other words, outrageous price earnings ratio, right? They haven't turned profit yet. Just like Tesla, I've been telling you, Tesla went public in 2000. I believe they went public in 2010 or 2012. I can quickly look it up, but even before they went public, price earnings ratio was already, huge. And even until 2012, they didn't turn profit at all. And even after 2012, profit was very meager. But why were during the dot-com bubble, it was pretty much the same. So that was exclusively due to a lot of bubble, but that was exclusively due to growth opportunities, right? So eBay's 1998 profit was 2.4 million, which was far below Sotheby's profit of 45 million. Sotheby. Sotheby is auction, famous auction, but they also real estate as well. Of course, two different divisions must be. Yet eBay's market value was more than 10 times, 10 times, Sotheby's, right? eBay's market value market capitalization. In other words, market price of eBay stock, right? Was still, they didn't make profit. 22 billion versus Sotheby. Sotheby's profit was 45 million, but the stock valuation by the market was only 1.9 billion. The net profit 2010, eBay's net profit was 1.8 billion, and that was more than 11 times that of Sotheby's. So there was a lot of high P/E ratio. Valuation primarily, valuation is made primarily by growth opportunities, right? Because it's all about future, expected future cash flow. So it's sensitive to reassessment of such prospects. When the market became skeptical of the business prospects of the most internet retailers at the close of 1990s, now they realized there was so much bubble. So they revised the estimate of growth opportunities downward, right? And stock prices plummeted. That's when the dot-com bubble busted. Growth prospects are intrinsically difficult to tie down. Yes. Think about it. Growth potential is, as I always say, potential is really hot air balloon. Potential is like hot air. I mean, there is nothing solid about the potential. I mean, they always say you have potential. I mean, they have potential. But, potential, it can turn out to be, it can turn out to be big, or it can turn out to be zero, right? So there are two key questions. First, what is the reasonable projection of the growth rate of profits? Second, what multiple of earnings is appropriate to translate and earnings forecast into a price forecast? So those are, and the next episode, is related to that. Now, pitfalls of price earnings ratio is basically, there's a difference between accounting earnings and economic earnings, right? Accounting earnings and economics. Arbitrary accounting rules, such as the use of historical cost in depreciation and inventory valuation, will lead to not using the price adjusted, not using the inflation adjusted cost will lead to EBIT seeming greater than the true EBIT, right? And they always, in accounting, they always want to do this. They want to make earnings look bigger than it really is, or basically, by making that earning look bigger, EBIT look bigger, that pumps up the, that pushes up the stock price, right? Whenever, during the earnings season, when they release this earnings, but when they actually file for taxes, they actually want to make EBIT look smaller than it really is when they file for taxes, right? Why? Because if EBIT is smaller than it really is, then after paying out interest, you will have smaller EBT, smaller taxable income. Then obviously, taxes will be smaller because taxes are some percentage of that EBT. So they all want to make it look smaller, right, for tax purpose. But when they release that information to the financial market, they want to make EBIT look greater than it really is to push up the stock price. And then they use, earnings method, which is practice of using flexibility in accounting rules to improve apparent profitability of the firm. That's why I said it's all accounting's problem, report pro forma or operating earnings. Operating, in other words, EBIT, not the net profit. I mean, EBIT is always greater than EAT, that goes without saying. And when they report, did I mention, 10Q, 10K? Did I mention that before? Now, I've been telling you, all publicly traded firms, are required to release their financial statement information, right? Quarterly, every quarter. Well, who do they report to? I mean, how do they release it? I mean, do they just, do they release it where? I mean, on CNN News or CNBC News? No. Basically, it will be made public. First, what they do is they file that quarterly report with SEC. Everyone knows what SEC is, right? Everyone knows what SEC. Is there anyone who doesn't know what SEC is? So if they file it with SEC, that's called $10Q report. $10Q. Okay. That's quarterly report. So basically, they file this, and it's called, Edgar. SEC's, so you can go to a SEC website, and it's called Edgar database. In Edgar database, you see all 10Q reports. Once they file it, and it's sort of not user friendly because it's for professionals, number crunchers. It's in a particular format that's easily, understandable by professionals, finance and accounting professionals, but not friendly to general public. And then once they file it with SEC, then this can be looked up, and that's 10Q report. And that way, the information, the earnings report is, released. And then annually they do. Annually, they update this report. That's called 10K report. 10K annually. Of course, annual reports are published and distributed to all public libraries, all in a periodical section. In the library. I don't know if it was periodicals, most likely periodicals. You can find, even BMCC library, you will find annual reports, right? You will find annual reports by, every company. I mean, the best place to look for it will be New York Public Library, and they will have all of the annual reports. And the annual reports are different from 10K. I mean, the contents are the same. I mean, actual financial statements are the same, but it is, annual reports are for non-experts, non-professionals, for, lay people. It's for lay people. So it's glossy booklet, a very glossy booklet with, a lot of pictures and a lot of, verbiage. But anyway, so what's going on? Oh, I hate this. No, I don't request signature. What? Go away. So So pro forma operating earnings ignores restructuring charges, stock options, blah, 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 blah. All this. Even GAAP. You know what GAAP is? Generally accepted accounting principles allows firms considerable amount of discretion in managing earnings. And it has, so these, so that's why we need, regulations. And they are, the industry is against regulation because they, especially, back in, why did, 1929, the stock market crash and the ensuing Great Depression? Why did it happen? Because the banking industry wasn't regulated. And the financial market wasn't regulated. There was no distinction between commercial banking and investment banking in those days. So all the commercial banks were, without withholding any reserves, they were all, invested all out in the stock market. And when stock crashed, then bank run. Banks, ran out of, reserve, bank run. And so the economy collapsed. So after the 1929 financial market crash, they legislated Glass-Steagall Act. And this Glass-Steagall Act, basically separated commercial investment banking from commercial banking. And it was fine until 1998. 98, I believe in 98, they lifted Glass-Steagall Act. Then, exactly 10 years later, after repealing Glass-Steagall Act, what happened? Exactly 10 years later, the financial crisis again, right? So after financial crisis, came the Dodd-Frank Act of 2009 or 2010. Dodd-Frank Act, that's, please look it up what Dodd-Frank Act is about. And then in 1998, I believe, there was a big scandal called, Enron. I don't know if any one of you remember Enron scandal. Enron was a total fraud. But a lot of big shots were involved in it. Dick Cheney, who was the vice president during first Bush administration, was one of the major shareholders of Enron, and many people, not only Dick Cheney, also George Bush Senior. George Bush Senior was also, or Junior. Either one of them was also on, the board of directors of, Enron. But Enron was a big scam. But it was, it was possible because the accounting firm for Enron was Arthur Andersen at the time. And then Arthur Andersen really cooked the book. They cooked the book, meaning, they forged and, falsified and forged and, did a lot of, illegal things. And they called it creative accounting, creative. So that's the problem with, accounting. Even GAAP allows a lot of, a considerable amount of discretion. So after that, so after the Enron scandal, Arthur Andersen was broken up. They broke up Arthur Andersen into two entities. One is, now it's called Accenture. Accenture is, it's just doing the, I don't know if it is doing the management consulting, but, Arthur Anderson. That name doesn't exist anymore, I guess. But Arthur Anderson was the biggest, accounting firm. In the old days, they used to call, Big Four, Big Five, and Big Four was Arthur Anderson, Ernst and Young, KPMG, and what was KPMG? Deloitte and Touche was like number 5 or number 6. Now it is like number 4, I believe. But anyway, so after the Enron scandal, they, what came about was, Sarbanes-Oxley law, which was, so you can, Sarbanes-Oxley, right? So you can read about it if you're interested. We don't have time for that. If you're interested, you can read about it. So here, in times of high inflation, so historically, you can take a look, price earnings ratio went down when there was inflation, right? And it's because they were not using inflation adjusted, they did not use inflation adjusted costs, underrepresent true economic value. In times of high inflation, historical cost depreciation and inventory valuation, right? Historical depreciation, not, inflation adjusted, but historical cost depreciation and inventory valuation underrepresent the true economic value. So depreciation and CGS is less than true depreciation and CGS. So EBIT is greater than true EBIT. And then P ratios fell dramatically in the 70s when inflation spiked, because markets assess that earnings are of lower quality, right? Artificially distorted by inflation, so warranting lower price. So price earnings ratios were lower because the market made its own adjustment to the inflation. Market made, in other words, market participants perceived the prices were unnecessary. Prices were, the earnings were of lower quality. So the demand for those the stocks were generally lower. Price went down, so price earnings ratio would go down. And the price earnings ratio is related to the business cycle, because dividend discount model is based on the economic earnings, which is net of depreciation. The maximum dollar firm can pay out without depleting productive capacity. That's economic earnings. But in accounting earning does not need to be equal to economic earnings. So however, normal or justified price earnings ratio assumes earnings will go up at a constant rate or on a smooth trend line. Now, price earnings ratio, earnings does not necessarily behave smoothly. In other words, it doesn't increase linearly, right? The price earnings ratio normally assumes that the earnings will increase at a constant rate. In contrast, reported earnings can fluctuate around the trend line over the course of business cycle. And the reported earnings, price earnings ratio, reported price earnings ratio is not like, actual mathematical model. Think about it. Earnings per share should be earnings per share at time one. But because the data available to us, we don't have this earnings at time one data. No matter at what point, we cannot have future earnings. We can have a forecast, but we don't have actual future earnings data. So what is being used for price earnings ratio is actually past earnings, right? Earnings at time zero is actually at the beginning of this quarter and the end of the last quarter, so it's already passed. So it cannot be a precise or accurate one of the pitfalls. And also this shows how the earnings per share behaves, right? How earnings per share behaves, depending on two different industries. One company is Intel. Intel is, of course, microchips making, so it's IT industry. IT would have more, fluctuation in earnings per share. Con Edison is, we all know, utilities are mature companies. Utilities don't have that much fluctuation in earnings because, think about it, it's natural monopoly. Utilities, why? Because it's not like you live in New York or Connecticut or some part of New Jersey where they're all wired by Con Edison. If you live in New Jersey, probably you don't. But in entire Northeast, Vermont, Massachusetts, all Con Edison. I mean, you cannot switch to. It's not like, oh, I don't like Pepsi, I'm gonna have Coke. No, it's not like that. Your home is already wired by one particular utility company. Then, there is no fluctuation. There is hardly any fluctuation in its earnings. And so Con Edison's growth rate is relatively low, 1.2%. Intel's growth rate is 10.3%. And then this 10.3%, of course, is way higher than Con Edison. And if you put a trend line, look, a trend line is the ultimate version of smoothing, right? So in other words, give me a break. So the earnings data would look like, if you plot earnings, right? It will look like this, right? And we can smooth it. We can smooth, mathematically, we can smooth it out, okay? And smooth it further. Okay. This is more like, a quadratic, not quadratic, a cubic function. Not cubic function. Cubic is more like, this is cubic function. Cubic function is like this. But no matter what type of, polynomial functional form it may be, we can smooth it out. And then, for example, if it is a third order is cubic function, but it could be, fourth order or whatever. But, if it is smoothed out, then, if it is third order, it can be smoothed into a second order, something like this. Second order, I wouldn't have this. But, second order can be smoothed to a linear function, right? Linear function. So trend line is the ultimate version of smoothing out, right? And we can tell from here 10% growth rate on average, right? That means slope of this trend line is 0.1, right? Of course, this is plotting the growth rate, earnings per share on the timeline, starting from 1995 through 2011, right? It's like, every year it was growing like, 10%, right? Well, 10% is 0.1, so obviously, but still, compared to that, Con Edison looks pretty much, as if there's no change. Earnings per share is always around, somewhere around 2. But look at this. Intel, in 95, its earnings per share was like, 1.5. But, 10 years later, 2005, earnings per share is like, around 2.5. It's like, 10% growth a year, right? It's even more than that, I guess, right? But then, and now this is P ratio. Previously, it was the vertical axis was earnings per share, right? But now is a P ratio. And what happened in 2009? Remember, that was, right after the financial crisis. 2008, we had financial crisis. The economy actually bottomed out in 2009. That was the bottom. And Con Ed's price earnings ratio exceeded Intel's only in 2010-2011 period, right? During that, a recession period, right? Intel's earnings rose at a far faster rate than its underlying trend. The market recognized the earnings performance was not sustainable, right? Intel's price did not respond to this fluctuation in earnings. So its P ratio declined. So, Con Ed doesn't, show that much, fluctuation. Where P ratio is overly high or low, must be judged only with reference to the firm's long-run growth prospects, as well as to current earnings per share. Relative to long-run trend line. Nevertheless, there exists, that means, that uppercase E flipped, that means there exists relationship between P ratio and growth. Intel's earnings per share trended upward. Its compound growth rate in 95 through 2011 period was 10.3 versus that's already what we saw. Intel's growth prospects are reflected in its constantly higher P multiple. General rule, P multiple tracks growth opportunities. Yes, that's the price earnings ratio. Look, 2009. There's a reason why I put that vertical line there. 2009 showed a drastic, from 2009, Intel showed drastic change. First of all, earnings per share drastically went up, right? Earnings per share. But price earnings ratio went down, drastically went down. And the again, it was right after the financial crisis. So the market perceived that high price earnings ratio may not be sustained, right? High price earnings ratio may not be sustainable. That was it. I think that was rather, yeah, here. This market recognized earnings performance was not sustainable. So the demand went down, so the price went down. But then look, just as the saying goes, buy the dip, right? Buy at the dip. That means, also Warren Buffett saw an opportunity here. Warren Buffett saw an opportunity, right? Low price earnings ratio means undervalued stock. Warren Buffett saw opportunity. I don't know if Warren Buffett really bought Intel in 2009 or not, 2009 or not, but it's basically Warren Buffett's strategy to buy the undervalued stocks, and this is undervalued. I mean, with this high price earning, this high earnings per share, if the price earnings ratio is like this is very, very cheap for its earnings power, right? It's Warren Buffett's strategy, and also it coincides with the conventional wisdom. You buy on the dip, right? Buy the dip, right? And this is in general, right? The price earnings ratio by the industry. Which industry has high? Biotech has the highest, right? And basically pharmaceuticals, chemical, all of these, have price earnings ratio above the mean. Mean price earnings ratio would be something like 15 or 16. And then high price earnings ratio, once again, is not necessarily good. It's got a lot of growth potential, but the growth potential, biotech, it can flop, right? Moderna did really well after the pandemic hit, but then these days Moderna isn't doing well. I mean, at least Moderna is great, but then doing well. There are many other pharmaceutical biotech who are just who turned out to be a flop, who couldn't take off. But there's a very high price earnings rate. On the other hand, below median, take a look. Aerospace defense, low price earnings ratio. Low price earnings ratio means what? High earnings power. Boeing, Lockheed Martin, General Dynamics, what are these companies? They make jet fighters, right? F-22 Raptor, F-35, whatever, right? Stealth, F-22 is stealth, F-35, all of these companies make jet fighters, and these companies have solid demand. Why? Because Department of Defense, DoD, Air Force, Army, Navy, they all, F-14 Tomcat, they retired already. But think about it. As long as there's U.S. government, and as long as there's U.S. military, right? And as long as U.S. Air Force or military wants to dominate over Soviet, Russian or Chinese aircrafts, U.S. government will spend money on aerospace and defense, right? So their earnings power is very high for their price. It's not that the price is low. It's just the P ratio. So that means, very high earnings yield. Oil and gas, there's no denying, there's no dispute. Oil and gas, and even a couple of years ago, what degree earns the most income? Petrochemical. Just by getting, bachelor's degree, how much money can you make? Petrochemical makes the most money. Petrochemical engineering. Of course, you have to be on the Saudi Arabia, oil oil drilling sites, but you're on a rotation. You don't have to be there whole year. I mean, and money center banks, healthcare, computer system, telecom services, industrial metals, electric utilities, home pharmaceuticals, chemical application software, right? Generally higher earnings power than the rest. Okay, and using. Okay, I want to. So here's the rest of them. I think. Now, using price earnings ratio to forecast the general stock market, right? Aggregate stock market. This is not that difficult. It's interesting. It's very interesting. You can easily follow. But here, combining P ratio, P analysis, and DDM, discounted dividend model, estimate price at horizon date. Yeah, you can estimate the price at horizon date. Value Line, Morningstar, and Value Line are two major companies that provide data and analysis. But you don't need to use their services. I mean, when you learn finance, I mean, the main reason for learning finance is to become your own security analyst, so that you don't have to buy data from these services. But if you have to, I mean, even investment banks, asset management firms buy, they buy the data from analysis and data from Value Line and Morningstar, because they believe it's cheaper to buy this than and more accurate to use their service than generating their own forecast, or more time efficient. Now, Value Line forecast of 2015 price earnings ratio for Honda is 14, and earnings per share $4. And Honda's 2015 price can be forecasted like this. Given 2015 price of $56, Honda's 2011, yeah, in other words, think about it. We know what basically discounted cash flow model is. We know what discount. You're discounting all the future cash flow, which are dividends, right? Discounting. So dividends may be forecasted, generated. You can generate forecast because a dividend, as long as you can find the growth rate of the dividends, right? Isn't it that difficult, right? When you know the growth rate, and then we know dividend at time 0, then dividend at time 1 is 1. Dividend at time 1 is dividend at time 0 times 1 plus G, right? It's so difficult to it's gonna be, and so on, right? And you can generate dividend forecast, right? This way, dividend at time 2 is then dividend at time 1 times 1 plus G, or dividend at time 0 times 1 plus G squared, right? And so on. But then if you want, if you're holding this for only for 4 years, let's say, for whatever reason, this is the part of the strategy of this fund manager, then they're going to hold Honda only for 4 years in the portfolio. Then you need, because it's not going to be infinite, you need 2015 forecast of Honda price, of Honda's price. And then, so you, if you buy value line forecast, I mean, it's a paid service, you'll have to pay. Then for that data, you need, that forecast. And then we can, based on that, we can find, Honda's value as of 2011, end of 2011. In other words, that's the that's time 0. And then the rest of it is, something you can just read up, right? Other, ratios, and then in my main lecture video, I explained everything about this, not just, I'm always saying that you don't take this for granted. When they give you, as an illustration, when they give you something like this, then you check it with what you learn. You check it with what you learned, and try to make sense of it. I mean, is this, so are they just bunch of numbers they just, threw in there? Or do those numbers add up? Do those numbers add up? Right? Do those numbers actually make sense? I mean, are they, plausible numbers? You can tell whether this is what just made up or not by checking, obviously when they use this illustration in the book, they wouldn't have just randomly thrown in these numbers. All these numbers must make sense, perfect sense, right? So do that, please. I explained all of this in my main lecture video, so please, go over this. And I would really want to wanted to do, but you can just read it up. You can read up, and by watching my main lecture video, this is quite an interesting section, because by using earnings per share, I mean the same concept applied, same concept for individual stock applied to S&P 500. So then you can make a forecast about the market in general, okay, and whether what would be the whether the stock is your stock is tracking the S&P general market, outperforming general market, or underperforming general market. All right, so that's everything. We are wrapping up everything about equity valuation. Next Saturday, we're going to move into bond portfolio management, which is chapter 11, but that needed to be you might wonder, why didn't we do that first? Because if it is about bond, why didn't we do that before stocks? because we did bond valuation first. There's more math. There's more math there. Most you have more math, right? You need to be involved with more higher level of math. So that's why I left it. But that will be our next topic. We are actually already into that, and we're almost finishing. We're already done, almost towards the end of that. Right, topic 3. I mean, today we are actually doing. So these, you must be caught up all the way to this convexity, right? Convexity. You must be all caught up to this. Any past ones, you go to my YouTube video. Okay. All right. So that's it for today. Yeah, Alpha, you have a question, Alpha?
Yes, sir. When is the next midterm? You said we have 2 midterms, correct?
You have 3 midterms and 1 final. So the next midterm will be midterm 2. It will be after topic 3. Will be after topic 3. Okay.
Okay. When would that be? When would that be?
I think that will be after spring break, kind of.
No, that will be before. This year, spring break is very late. This year, spring break is from 15, April 15th through 22nd.
26.
Okay.
I believe.
The
Yeah,
26th.
whatever maybe. So we have a lot of time before the spring break. So probably we'll have even midterm 2, midterm 3 before the spring break. Okay.
Okay. Professor, I do have another
Yeah.
question. I already
Yeah.
did the
Okay.
spreadsheet.
Okay. Hold on,
Okay.
Sebastian. Can you hold? So basically, the class is dismissed. So you may be excused if you don't have any more questions. So have a great day, everyone. I will see you guys all next Saturday.
Likewise.
Okay. All right. Thank you. Take care. So I'll stop recording. I'll stop recording, and I will stay on. I will stick around. So if you stick around, you can. Okay. I'll stay.